Today is all about high yielders, but finding them in a safe way. Fellow investors, bonjour. This is Mike Roux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Roux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero, and today we have an unusual topic for us, right?
Right, because while we do not focus on yield at all, we have said a few times that not all yield stocks are bad, but then what does that mean? It could leave investors in more doubt. So I thought we should expand on the topic today. So we'll see what's safe high yield stocks and which ones are your favorite, Mike, because yes, you do have favorite high yield stocks.
I mean, even shocker, I do have some in my portfolio. Can you imagine that? Because here's the thing. I like to say that I am yield agnostic, and this is how it goes also at DSR. In our view, a good company is a good company. If it has a high yield, well, then there are some reasons for that, but it's not going to be discarded or favored because of the yield. It's all about the quality. And yes, there are some high quality stocks that on top of that offer a high yield. And I know a lot of investors love to get those numbers, those dollars deposited in their account every month, every quarter. So I decided to go a little bit forward this time and dig a little bit deeper in all the resources that we have at DSR to find companies that not only in my portfolio, but also others that could offer a high yield, but that has less chances to burn investors down the road.
Right. And before we start, a quick reminder that you should not consider the stocks mentioned in this episode as buy or sell recommendations. You must always do your diligence before buying or selling any asset. First, Mike, we need to put yield in context. At Dividend Stocks Rock, like you just mentioned, we define ourselves as yield agnostic. However, we tend to dislike high yields. So why is that?
Yeah. Well, I start from the premise that there's no free lunch in finance. Whatever you are buying, you're not necessarily getting an amazing deal because there's also the counterpart that is selling, thinking it's really time to sell and move on. So if you buy a stock at a cheap price, you're not necessarily getting a good deal. Maybe it is, maybe it's not. If you have a high yield, it's also for the same reason. There is something explaining why there is a high yield. I mean, people in general are not stupid. Investors are not stupid. If you're thinking that you're smarter than all the other investors in this world, think again, my friend, because I mean, we all make mistakes. I'm the first one to admit my mistakes, actually. So if a business offers a yield of 12%, the market clearly sends a signal. Like there is not enough demand for that type of investment. And we're talking about companies today, not like strategies or investment products. We're really talking about like a business offering a 12% yield. There is something wrong. And most of the time, when you start looking at the metrics, you're going to realize that the metrics will not look good. So you may tell yourself a great story, but similar to what we have seen with BC not too long ago, when the yield hit more than 10%, that was a scream from the market telling you there is a problem with the dividend and it's likely going to get cut. And well, big surprise, it happened. But at one point, if you look at the numbers, it's going to tell you why. So in general, a lot of companies offering a high yield will come with a baggage of other types of risk, like not much growth, maybe very high payout ratio, maybe that the company is actually seeing their revenue going down because they're in a cyclical decline and they're not able to keep up with competition. There are plenty of reasons, but there is something. So it's worth the time to investigate a little bit further. It's not necessarily, oh, it's a high yield, I should sell, but you need to understand what's the reason behind it. If you cannot find the reason behind it, you're missing the point. And if you're missing the point, well, you expose yourself to a risk that you're not even aware of, which is kind of dangerous in my mind.
But then we need also to address what's a high yield. I mean, is it anything around 7, 8, 10? You've mentioned 12%, or would stocks offering a yield around 4, 5% be considered high yield.
Yeah, that's another thing. I mean, we need to draw a line somewhere, and
Hmm.
for the purpose of this podcast, we're going to use like 5% as a high yield. However, I would need to add it also depends on the market you're in. If you look at the stock market at the bottom of 2008 or even during the quick crash of the COVID in 2020, you would have found a lot of companies offering a high yield like 5, 6, 7% that are completely safe, right? I mean,
Hmm.
Canadian banks in 2008 probably offered something around like 8 or 9%. I don't even remember, but I mean, they lost 50% of their value within a few months. So if they used to pay between 3 and 4% yield, now they jump to 6 to 8. And like in 2009, they all recovered, and it was just an amazing timing to get those companies at a very high yield. But it was more due to the market and the fear and the panic around it than the actual business. Right now, we're completely on the opposite of this spectrum in a sense that we are flirting with all-time high markets. So of course, you could even consider that some companies offering 4.5% could almost be high yield. But in general, we'll go with 5. We're going to draw the line here. And of course, that's just like to define our perception of a high yield. Above 5%, there's definitely something not wrong, but there's a reason why the yield is so high.
And what's a safe one? How can investors identify them?
Well, then you need to look at metrics, right? The yield itself is not going to tell you much. I mean, and we have seen companies with low yield not doing that great either. So it's not necessarily because you have a stock offering a 0.5% or a 1% yield that the business is going to do amazing. That's not enough metrics to understand what's happening. So first, I will always go with the dividend triangle because once again, you want companies in your portfolio that are making money, that are likely going to make more money in the future, and those sales are going to transform into profit, and those profits will transform into dividend payouts. If you look at the dividend triangle of a high yield stock and you see that the revenues are declining and then margins are getting hurt, so the company is making less earnings and has not increased its dividend for the past 5 years, well, you're kind of like looking at a struggling business. And then the question that you should ask yourself is not about the yield, but do you want to hold struggling businesses in your portfolio? Like, what's the point of an investor? Is to make money with his portfolio. It's to generate income. Fine, okay, but is the income is going to be stable and sustainable if the business has a hard time to find new clients and sell their products or their service? That doesn't make much sense, right?
Hmm.
Once you have done looking at the revenue, the earnings per share, and the dividend trend, then you can go a little bit deeper to find out what's the explanation behind all this. So you can look at other financial metrics such as the cash flow from operation, the free cash flow, the payout ratio. Because once you start to build a combination of struggling sales, declining earnings, no dividend growth, very high payout ratio around 100% or above 100%, and then you have like the free cash flow that does not cover the dividend in a year, now you're just piling up a lot of signs that yes, you have a great income coming in the next quarter in your portfolio, but chances are it's not going to it's not going to last for a long time. So it's
Hmm.
just about identifying all the metrics around the sustainability of that dividend payment.
And again, it is crucial to give more weight to the numbers than to the narrative, right?
Yeah, definitely. A lot of investors will tend to say, "Oh, but I like the yield." I mean, have you seen that yield? The yield is great. I'm getting payouts. Oh, it's been like 3 years. I'm getting like this huge dividend, so it's amazing. Yes, it is, but that's not enough. Once again, I mean, I could spend a fortune to give treats to my children and buy them whatever they want. They're gonna feel amazing and they're gonna say, "Oh, that's great." I mean, it's been 3 years that dads bring us to like 5 vacation a year, and they bought us cars, and now we have like 3 condos across the world. And then that it goes bankrupt because you definitely do not have enough money to do that. So the narrative is not that important at this stage. The numbers will tell you if the dividend is safe or not. And I made that mistake myself with Algonquin back then, where
Mhm.
I trusted a little bit too much the narrative of growth by acquisition, the greening process, and this ability of the company to acquire more clients, generate more cash flow, and everything was fine. Well, if I had looked a little bit more closer to the numbers back then, I would have noticed that the funds from operation were in decline, the earnings were in decline, and even if the company just increased their dividend a few months before, it was putting the balance sheet in great danger. I did not put enough attention to the numbers, and I told myself, oh, the narrative is going to bring the company back on track. Well, I was dead wrong. And it's exactly what just happened with BCE. I mean, we talked about it for like 18 months or something like that. And
Mhm.
every single time that we mentioned it before the dividend cut, I got the same replies for dozens, if not hundreds of investors telling me, yeah, they've been around for so long. They're not going to cut their dividend. Everything's going to be fine. You're overreacting, Mike. Like, just trust this amazing business that has been around for decades. I'm like, yeah, that's an amazing business. It has been around for a decade, but management did their calculation right. So again, it comes back really to the numbers.
All right, so to illustrate all this, we will now share some of your favorite ones. For each, you will share your bull case or what makes it safe, and also your bear case. So let's start with Alliance Bernstein. I'm never sure if I pronounce it well, but ticker is AB.
Don't worry, I'm not sure either. So it's either Bernstein or Bernstein. Like,
Something like
we'll
that.
let our friend Anglophones tell us which one is the right one.
So AB is an asset manager with a yield of almost 8%. What is your bull case for it?
So for asset manager, the name of the game is really the assets under management. Like, the beauty of this business model is they get money from retail investors, from pension plans, from institutional investors, and then they charge a fee on those assets. So it's recurring, it's stable, it's growing, and most of the time, institutional investors are not going to fire their portfolio manager every quarter. So you could expect a relatively good client retention over time as well. So Allianz Bernstein is known for its fixed income asset with good performance. They have also a private wealth division that is doing good. And again, tying this up to those recurring fees, that also helps them to pay that juicy dividend, which is variable. So one other thing that I like about this dividend model is they will not tie themselves up with a high dividend payout. If they have a bad quarter, the dividend will decrease. The next quarter, if it goes better, they will increase the dividend. So you cannot necessarily live on that as a budget, but
Mhm.
overall, you're going to get a lot of dividend payouts. And the dividend triangle over the past 2 years, the revenue and the earnings are actually going on an uptrend. So that's also another plus on their bulletin board.
But Mike, nothing's perfect. So what is the bear case for AB?
Yeah, so as much as it's great to depend on assets under management to charge fees, those assets could go down if the market goes down. And as an asset manager, there's nothing you can do about that. So you just
Mhm.
see your revenue and earnings melting down without any reason. The other thing is classic asset manager, portfolio managers like this are also facing big threats coming from ETFs. The ETFs trend has been there for like 15 years now. If it's not 20, it's growing every single day. And of course, putting more pressure on those portfolio managers to reduce their fees to make them still attractable. So it's always a little bit tough on the margin. As I mentioned, the variable dividend is great, but you cannot count that in your budget as well. But it makes it a safer dividend than many companies that will tie them up with being forced to increase their dividend every single year.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. Okay, so moving on to Enterprise Products Partners EPD, a midstream company offering a yield of nearly 7%. What is your bull case, Mike?
So EPD, it's one of the largest diversified pipeline company in North America. So it has like a wide network of pipeline, storage, processing facilities as well, and they link key supply basins in the US to major end market. They benefit from the scale, they benefit from long-term contract with their clients. I mean, on this podcast, we have discussed at length Enbridge and DC Energy. So we have EPD that runs a similar type of business model. So it's just that they're getting their oil and natural gas from basins in the US instead of like oil sand in Canada. But that's pretty much the only difference. Management is quite conservative and responsible with their budget and their dividend payments. And of course, as long as we need those commodities, well, they own like very high quality assets that are very hard to replace. So again, that ensures like stability of payment, recurring cash flow equals recurring dividend, of course.
And how would you describe the bear case?
Well, unfortunately, EPD also depends on fossil fuel volumes for growth, right? So while we need it now, there's still a big push to reduce that consumption. And if it happens, well, it's going to be hard to turn around because this is their business model, literally. So the
Mhm,
growth
mhm.
potential could be capped. And that explains also why there's a big yield. The function of this kind of business is to actually distribute as much cash flow as possible to shareholders. So it is kind of like the trade off that you're willingly making. Say, well, I'm going to buy something that will look a lot more like a deluxe bond, like a company that will not see its stock price skyrocket, but instead I'm going to receive a lot of money back every quarter. The other downside, of course, is the master limited partnership structure, the MLP structure. I don't want to go into details because I hate taxes. I'm not an accountant, but if you ask your accountant about MLP tax structure, he's probably not going to smile. There are like more taxes involved depending on the account, depending on the country where you live. You need to fill up more forms. So be aware that if you go into that, it's going to be more work for you and maybe more taxes as well. But then go see your accountant. I don't even want to receive any questions about that. This is one reason why I don't invest in that kind of stuff. I mean, it's just, I like to keep things simple. So when
Right.
something is not simple, of course, it's going to be part of my case and the reason for me not to go forward. I'm not saying that you should, but just know what's going to happen next. And of course, on top of like having like limited growth opportunities, all pipeline storage companies are capital intensive, so they are more dependent on the interest rate environment and their debt load. So those are the things that you should monitor quarterly just to make sure that the company is not doing something stupid.
Okay, so still in the US, Vici Properties is a REIT in a niche industry with a yield of over 5%. What makes it a safe high yield?
I really like the business model because they focus on casinos and that's very niche. But what is great there is when they buy new casinos or new properties, there are not that many buyers, not many companies have the liquidity and the expertise to go there. They benefit from super long-term contract. We're talking about more than 40 years with great location, escalator charges there. So they are protected against inflation. They can increase their rent easily. And they use a triple net lease model. So that means that the tenants is responsible for more expenses and Vici Properties just get the benefit of renting those properties. Of course, with
Mhm.
those great location, it's pretty rare that you want to move out of Vegas with your casino. You're pretty wants to stay there on the strip. So a great way to tie up your tenants kind of like forever. The company's super stable. We have like a dividend growth that is also every year. So for a high yield of 5% with a continuous dividend increase that will match inflation, I think it's not bad as an investment.
Now, what's to be aware of about Vici?
Well, we just recorded a podcast on REITs not too long ago, right? So it's
Hmm.
always the same game. It's a game of leverage, a game of interest rate, managing inflation and all of those expenses versus your escalator contract. You want to make sure that it's really well built in. Growth is limited. I mean, it's great to be in a niche, but at one point it's going to be hard to find new tenants or new properties to purchase. And also always keep in mind that casinos are in a cyclical industry. So at one point they may run into problems with some of their tenants. So that's always a possibility. And since there are major tenants, that could lead to major losses. So it's great to have a good location, but if no one is in your location for like 8 months or a year, the time that you like for the turnaround, that's a lot of revenue that are lost, and you still have to spend money to keep the property maintenance intact.
So, by the way, listeners, the episode we did on REITs was because a lot of REITs are puzzling investors for like a couple of recent years. We decided to do a complete guide. I will put the link in the show notes at thedividendguideblog.com/237. So there are also good high yield companies on the Canadian side, Mike. One is Brookfield Renewable, also trading on the US market and offering a yield between 4.5 for BECP and 5 point almost 9 for BEP.UN.TO. Why is there a difference between BECP and BEP?
Yeah, I'll put this one on purpose, right? Now,
Yeah.
like getting very complicated. So just to add to the mix, and it's kind of funny because you'll see that in the bear case, like the first thing that you're going to talk about is complexity. And we already start with the yield. So Brookfield Renewable trades under 4 different tickers. So
Mhm.
2 in the US, 2 in Canada. So they trade under a corporate class share. So like a regular business, that's the BPC. So BEPC, and it's the same ticker on the US and the Canadian side. And then it trades under units or trust units under BEP or
Right.
BEP.UN in Canada. So the difference between the yield, because they pay the same dividend in dollars, but the stock price and the unit price are different. And the reason first why they created a corporate class share was because they wanted to attract more investors. So all the institutional investors or the ETFs and mutual fund companies and pension plan will not likely be tempted to invest in trust unit. They're like me. They like things simple. They hate taxes, I guess. So they are more likely to invest in corporate class shares than any other types of units and trust units. So when they did that, I think it was towards the end of 2020 or in 2021, I can't remember the exact date, but they just created another type of class share. So if you're looking for a better combination of price appreciation and dividend growth, the corporate class share is so far a little bit better because technically it's the same company, but then the stock price will be driven by demand. And technically, you should
Mhm.
have higher demand from investors for corporate class shares. So that explains the
Right.
difference between both. But if you're looking to buy a stock that has a higher yield, well, you can go for the trust unit, especially if it's in a tax sheltered account. It's going to simplify things as well. And then you're going to go for BEP. So now that we have put that aside, there is a bull case also. There's also
Right.
a reason to get it, not just a yield, right? So Brookfield Renewable, pure play on renewable energy. We are talking about a great diversification in terms of sources. So you have about 50% of the business is generated, the revenue business is generated by hydroelectricity. The rest is wind, solar, and storage. They are present across the world as well. And they also have the parent company, Brookfield Corporation, that can back them up and fund some of their projects. So it's a capital intensive business, but they have access to so much money that it's not necessarily a problem for them. And we're
Mhm.
talking about a company offering like mid single digit to high single digit. So we're talking about like 5-ish dividend growth rate on top of having like a very nice yield that goes between 4.5 and almost 6%. So you kind of have like a great package here where you have a good business for the future with solid metrics and increasing a payout that is actually quite generous in the first place.
And what would be the bear case?
Well, I spent like 3 minutes explaining just the difference between all the tickers. So you can guess that complexity is an issue. So here's the thing Brookfield Renewable will buy assets like power plants and then will improve their efficiency. And then they will do what we call asset recycling. So it's really kind of like buying an ETF of renewable utilities. They're buying a bunch of smaller businesses, they're improving them, they're recycling them, so they're selling to buy another one, and so on. So it's really hard. If you go into their financial statements, you will not be able to look at every single smaller business's numbers. You will
Mm.
have to trust management because it will be regrouped by segments. So numbers are not going to be super clear. You're not going to be able to get to the end of everything of what they own and how it's doing. So you don't know exactly if that wind farm is actually profitable or not. It's impossible to know. And in order to determine if the dividend is safe or not, you have to work on funds from operations and fund from operations per share. They look great on papers, but they're calculated by management. So once again, you have to trust them. My point is, you cannot really fake a distribution. That's really money that you have to spin off from the business. Most of the time, when there's, let's put it that way, like not fraud, but like creative accounting, when it gets too creative, whenever there's a market crash, most of the time you will find out about those companies because they cannot hide anymore. And Brookfield has been around for several years. The Brookfield family has been increasing their distribution, each of them, like infrastructure, corporation, asset management, and renewables for more than a decade, and still everything is running smoothly. So it is a big risk and you have to consider it. But so far, it has been proven very solid. But keep in mind, for Brookfield Infrastructure, there was a short report that came out, I think, towards the end of 23, if I remember correctly, explaining all this complexity and the fact that some of those utilities held inside Brookfield Infrastructure were probably not profitable. That shook the stock price, but in the end, it's been 2 years now and the company's still increasing its distribution. So I guess that the short report was not exactly on point. But again, that is something to keep in mind. And if you go inside Brookfield, you must be okay with trusting management. And maybe one day you're going to like read a bad headlines about that and it's going to turn sour. So that's just something to keep in mind.
So maybe not invest like 25% of your portfolio in that one.
Yeah, that would be a pretty smart move not to do that.
And of course, we could think about banks when we talk high yields in Canada, but let's look into another one today. First National FN.TO with a yield around 6.5%. What's the bull case?
Yeah, I mean, we didn't want to talk about banks because some of the banks right now are offering like a yield around 5%. But I mean, we keep talking about banks all the time. So let's go First National. I thought that's probably the first time that we discussed today. I'm kind of surprised actually that the dividend is sustainable. And on top of that, they find ways to grow the dividend like very like almost every year, and they offer special dividend from time to time on top of that. So pretty solid for a high yielder. So First National is the Canada's largest non-bank mortgage company. So they originate and underwrite mortgages. They have over 150 billions in mortgages under administration. They focus, of course, on prime residential, commercial mortgage, single family, multi-unit, like the classic thing that banks are doing. But what they do is they have very special relationship and long-term relationship with mortgage brokers. And also they do not use deposits like banks to fund their mortgages. They actually get the money from institutional investors, or they sell mortgage-backed securities to get the money to fund the mortgages. So slightly different business model here because you rely more on third-party funding, not necessarily on your own money. But with that great relationship with mortgage brokers, they are able to underwrite a lot of mortgages across Canada. They definitely have a strong underwriting process because their provision for credit losses are not crazy. I mean, they went through a lot over the past few years and yet never cut the dividend, kept it alive, actually increased it, and find ways to also reward shareholders with those special dividends, which is quite a feat in my opinion.
Now, what are the risks or the bear case for this one?
Well, the classic here, we're talking about mortgages, we're talking about financing, so housing market, interest rates, how consumers are behaving. There's a lot of competition to get those mortgages, actually. I mean, you have like all the banks, you have like some insurance companies that are doing that as well, and now you have like those private lenders like First National. So you have a lot of people doing exactly the same service. And let's be honest, a mortgage has become from a commodity. You shop around, you get the best rate. There's no service after that. You get the money, you pay the money back with interest, and that's the end of the story. There's nothing else that comes with a mortgage. So most of the time it will comes down to, are you able to offer a better rate than your neighbors? And that's pretty much it. Finally, since they rely on third party funding, they always have to make sure that they maintain those relationships. So it could dry out or slow down, like the interest could slow down from institutional investors as well. And that would limit their growth potential at the same time.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Let's end with Telus, a telco that has now reached a yield of around 7.6%. Telus did not always offer such a high yield. Mike, is it really a safe one? And could you please describe both cases for us?
Telus was once a great example of a company that offers both growth and income. So with a yield that was more likely around 4%. Now it went up pretty high because the company never stopped increasing their dividend. And as of 2020, before 2025, the latest 5 years were like a 7% dividend growth rate, which kind of crazy. The stock price did not follow, of course. And that brought us to today with a super high yield. Full disclaimer, I have it in my portfolio. I do also have Brookfield Renewable. I didn't mention it earlier, but I've mentioned it several times. So for Telus, I mean, it's a big telco. I don't think it needs introduction, right? 80% of their revenue is coming from wireless and wireline. So the cell phones, the internet is the bulk of their business. It's 93% of their EBITDA, so most of their profit as well. They also work on growth opportunities such as Telus Health, Telus Agriculture, and Telus Digital. Those, I mean, that was like the fundamental of the investment thesis here, where you have like very solid revenue generation from wireless and wireline services. You can invest into those more tech-oriented services that could eventually help the business to grow even faster. That didn't turn out well after COVID. Now it's getting a little bit better. We have Telus Health at a nearly revenue of like $500 million, so $500 million. We have Telus Digital getting close to 1 billion during Q1 of 2025. So numbers are getting good now. The cash flow situation is getting better over the past roughly 6 quarters. So I mentioned it during 2024. I monitored cash flow from operation, free cash flow, and capital expenditure, and all numbers are getting back on track. The number one thing that I was looking for in 2025 is a new dividend growth policy, because their 7 to 10% growth policy ended up last year, and they started 2025 with a 3.5% increase, mentioning that they target between 3% to 8% through 2028. So still probably closer to the 3% than the 8, to be honest, but still pretty good for a business now offering 7.5% yield. On the bear case, though, I mean, we also how BCE story ended up. So Telus is in the same bag, in the same where it's a capital intensive business. They have a lot of debt. They have to deal with the interest charges. The overall thesis for 10 years, the narrative was, we're going to borrow a bunch of money, spend that to increase our network, expand our network, build the 5G technology, and then we're going to rack up a bunch of cash flow. It's getting better on the cash flow side, but still they're not out of the woods yet. There is intense competition to acquire clients, of course, and governments, the federal government wants more competition. So that's not going to slow down anytime soon. So on one side, you have a business that is very stable, that has a long dividend growth history, the payout ratio is in order. On the other, still the same threats that are looming with high debt and high competition. So ideally, it's great to see the dividend that keeps on growing through 2028. But the next thing that I'm going to monitor in the coming quarters is if Telus is also able to pay down a little bit more of that debt, because there's a limit of like how much debt you can carry on. So at one point, the fun has to end. I mean, that has to put his wallet back in his pocket and say, no more Disneyland this year. You have to pay down your dues.
So, listeners, you can see how thin the line can get here. This is why I would like to end with a quick guide to avoid dividend cuts, Mike.
Yeah, and before I get there, I would like to add another note as well. I'm well aware that this podcast could age very poorly. Like maybe in 2 years from now, like one company in that list will cut its dividend because of unforeseen events. So the point here is really to monitor any high yield, any stocks above 5% every single quarter to be on top of things. Because what I've been saying right now may not be that great in 6 months from now. It can go fast, very easy. I mean, again, going back to BC, for decades, I saw it as a good deluxe bond, very safe. In 23, we downgraded it at the SR the first time, and then in 24, a second time. But I mean, it happened relatively quickly. For many years, there was just like that great business with a lot of stable revenue that continues to increase their dividend, and there's nothing to be afraid of. So just keep that in mind for future purchases. A quick guide here. Well, the first things is always this. The market is usually right about a lot of things. So when there's a high yield, there's a signal. There's something that you need to investigate. It's not enough to discard or to buy a stock, but it's definitely a signal that you need to know more. Need to know more? Well, you need to look at the dividend growth, the trend. I mean, if there is any dividend increase first, and if in case of like Bell, what we saw is 5%, 5%, 5%, 3%, 0%. Already, you see that there's a problem here. The second problem that is going to come is, of course, payout ratio that keeps on going up. So if you see no dividend increase and you see payout ratios going up, you can bet that most of the financial metrics are not going to look good going forward. Leading to number 3, the dividend growth trend and the payout ratio will be the consequence of a company that is not doing well. So that will be the result. If you want to know more about the cause, then you look at the dividend triangle. So number 1, high yield needs investigation. Number 2, the dividend growth trend and the payout ratio will tell you what's the current status. If you want to know the results for the cause of that, you go to number 3, analyze the dividend triangle. So the trend for the revenue, the earnings, and the dividend over the past 5 and 10 years, it's going to tell you a lot. And when you see poor numbers there or poor trends, well, then you need to dig a little bit further. I learned that lesson about Algonquin, as I mentioned earlier, and what I did for BCE at that time. I did not have BCE back then before the dividend cut. I still don't have it either. I never bought it anyways. But what I did is once I realized that most of the numbers were not looking good, I did the hard work. You go into the financial statements and you find what's hurting the earnings. And then you discover, higher interest charges quarter after quarter after quarter, higher debt quarter after quarter after quarter. And then you look at the cash flow and you realize, so they're not generating enough cash flow to finance all their projects at the same time, plus paying the dividend. So then you see the company slowly but surely digging a hole and getting into that hole. Like every single quarter, it gets worse. So then you have the numbers telling you the loudest story possible, the clearest story possible, that the dividend was not sustainable. And this is what we got. So high yield, dividend growth trend, payout trend, and then the dividend triangle, and then you're full circle. Most of the time, you'll be able to prevent most dividend cuts unless there is like a catastrophe, an unforeseen event that nobody can imagine before. But for most of the other types of dividend cuts, they're going to be prevented by looking at those 3 steps.
Well, thanks so much for your insights on high yielding stocks, Mike, and also for sharing your favorite ones. Listeners, remember that while receiving dividend income is great, buying quality companies that will continue to grow is what matters the most. To understand the concept better and create a sustainable dividend income, enter your name and email at thedividendguyblog.com/income to download the Dividend Income for Life guide. For our show notes and related content, visit thedividendguyblog.com/237. Next week, we will dive into analyzing a mixed portfolio. Hit pause and the subscribe button underneath our podcast logo so you don't miss it. And until then, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.